What's going on, guys? Welcome back to another episode with the Landlord Society. We're here to talk about all things property, how to retire early through the Australian property market. I'm here with HD. He's on a farm somewhere in the middle of rural Australia, some regional area where he's probably got a property or two there. We'll get into that later. So this is a super quick, relatively quick, punchy episode. There's a few topics we want to go over. Buying property through trusts, how to optimize your borrowing capacity, different strategies around first homeowners and paying lenders mortgage insurance, how to outperform the majority of property buyers in Australia, because it's a very competitive market, as I'm sure we know. Borrowing money on principal and interest versus interest only, and whether we should be buying apartments or houses starting out. I know a lot of first home buyers look to apartments because that is something that a lot of these government schemes allow us to get access to when we're just a first home buyer. So Handol, talk to us. Whereabouts are you at the moment?
Yeah, so we're in rural SA today at the moment, and so I'm going to do a little bit of a tour around. Let's pick this up and show everybody around. Oh, beautiful behind us. Okay, here we go, and got a couple of horses here, these guys are.
This is farmland.
Yeah, they're a hoot. They're an absolute hoot. Look at that. What are they up to? They're just taking massive dumps, that's what they do, I guess.
Fertilizing the lawn.
Yeah, that's right. Just fertilizing the lawn and I guess cutting them at the same time. So yeah, we're just on a farm. There's an alpaca here somewhere. Can't find the alpaca anymore. But yeah, there's sheep everywhere. And we're just here on Easter long weekend, and we're just going to be, I guess, doing a podcast. That's what we're going to do today. So looking heaps forward to what we're going to chat about. You raised a lot of stuff today, Chaz. What are we actually going to start off talking about?
Yeah, so a lot of lenders do require lenders mortgage insurance. All lenders require LMI when you borrow more than 80% of the value of the property. Especially if you're a first home buyer. A lot of these schemes, even though they're great, you might skip stamp duty. They might waive that. You still have to pay the LMI. Now, a dilemma that a lot of people are in is that, is it worth waiting until you have the full deposit, so that time that you have to outlay to save for the deposit for the property, so then you don't have to pay the lender's mortgage insurance, because your expenses will be obviously a lot higher, or getting in now. Now, bear in mind that the RBA has announced that we're potentially going to see rate cuts in about September. So when that happens, demand is going to go up. So we have almost a time frame, like a time crunch of, we need to save a deposit. If we're in that situation, we need to save the deposit to get into the property before the RBA decides what they're going to do with interest rates. But the other thing is that what the RBA says and what they do are usually completely different things. They usually, during COVID, they said that they were going to increase rates, and they did the exact opposite.
Let's talk about you raised a couple of really interesting points there. So first of all, LMI, to LMI or not to LMI, that's actually the primary focus. I mean, we've raised a lot of topics to talk about today, but I wonder if that might take the whole lot of today's conversation, and then we might unpack some of the other topics in another episode. But anyway, we'll see how we go today. Basically, LMI is a very interesting one. All right. So LMI, if you go from 80%, LVR, going from 80% to 90%, so that means you're borrowing from 80%, right, increases to 90%. If you actually do that, then LMI is going to kick in. And I think that's the basic information that followers need to, listeners need to know before we can embark on this discussion. So typically to do that, you actually need to borrow more money, right, than the 90%. And that's so that money could go towards insurance. So what I've encapsulated in that sentence is that the LMI is going to be around say about on a $400,000 loan, it's going to be anywhere between 8 to about 15 grand between those figures there. So and that gets capitalized into the loan, which means then you just basically borrow more money to be able to pay for that. That's basically what's going to happen. So the bottom line of the property acquisition will show that you have paid $10,000-$15,000 more for your property. It'll say that. Now, however, and the question therefore arises, and they go, okay, well, should we LMI or not LMI in that situation? That's the question that we're asking. Well, here's the thing. If let's say the LMI is $10,000, right, and interest rate is say 6% right now. 6% of $10,000 is $600. So if you're paying just the interest portion of that in a given year, then you're paying $600 that year. That's $50 a month. And that means it's cheaper than one of these things that people own, right? It's a phone.
Oh, right. Yeah. It's...
I mean, like, a phone plan costs like, what, $70 to $80 a month. And yet people are willing to get a phone, but they're not willing to get a house that's going to grow up in value. Now, over the last 25 years in Australia, Australian property prices, house prices have grown at 6.8% on average over the last 25 years. Yep. That's all through COVID, all through global financial crisis, all right, even including the dot-com bubble, basically.
Yeah.
Then let's say on a safe sort of margin at 5% growth on a property. Let's say you bought an average property with an average growth at $400,000, then that property is going to grow up by $20,000 that year, and yet you're too afraid to spend another $10,000 to achieve it, basically. And it's not even that $10,000 that you got to pay up front at the beginning, isn't it? Like it's actually just $500. It's $600 a year, $50 a month to actually capture that growth at the end of the day.
Exactly. So the growth that you're getting by purchasing the property full stop is going to outperform what you would have otherwise spent in LMI.
But disclaimer is that as long as you buy the right property, that's the case. So
100%. Exactly.
If your property is a shit property and it's not going to grow up in value, then I'd argue that getting it even without LMI, even with all the full deposit on a 20% plus stamp duty and closing costs, is still not bloody worth it. Does that make sense?
Yeah.
So then don't even go there. But if there's a good enough property deal, then LMI is a fantastic tool to achieve it. Now, this is contrary, right? And like most finance brokers will say, oh, no, it's actually not good. And they'll skew the investor's decision in a particular way. Or that's only because the finance broker hasn't got much experience buying property themselves, or they haven't seen it with their clients, because their clients are usually just mum and dad investors just buying their own home, and they want to reduce that risk as much as possible. And not that LMI is, risky or not, but like, they will always err on the side of the caution just to protect their own ass and just to protect themselves, which is not the point of, true finance broking, which, I believe the true finance broking should be, geared more towards the investor's success, the client's success. But and then of course, if you're expecting anything like this from the bank, well, forget it. They're not gonna do anything like this anyway. So that's why you have to work with the right finance brokers to get the right advice on LMI. That's for sure. But it is up to you as an investor to then make the right decision to whether or not you should pull the LMI to then embark on an investment that will actually outpace the outlay that you make at the beginning in the form of an LMI.
Exactly. Yeah, exactly. So if you have a good, that's why we recommend a lot of the time people invest in themselves, or they work with a professional to help them get into the property market so they can actually acquire the right property that will outperform whatever it is they're trying to do. So obviously we do that, but all we're saying is do your research. Make sure you understand what you're getting yourself into when you buy a property.
Absolutely.
You want to be buying in the right locations.
Absolutely.
For sure. And also work with the right a good finance broker. That's a huge point as well. That makes a world of difference that I've experienced, and I'm sure you have too, Handel.
Yeah, that's right. Absolutely.
Yeah.
Another thing that I would also I'd like to comment on is your comment about the RBA rate cuts and rate rises, right? To be honest, right, I don't really understand why people place that much weight and effort into understanding or predicting the interest rates. Interest rates do cause some market changes, but let me ask the audience, right, today, is that, okay, we had interest rate rises all throughout last year, right? All throughout last year. And interest rates dropped all throughout the year before that, or the 2 years before that, right?
Yeah.
Through the rate rises, what happened to the property market? Did it go up or down? It went up.
Yeah.
Right? Yeah. It makes logical sense to most investors, right? And I mean, unless you're completely stupid, right? That when interest rates go down, then there's going to be more liquidity out in the market, and it's going to go into assets and whatever. And when the cost of money goes down, then obviously it's going to increase, even inflation as well, and that's going to be all fed into the prices of homes, right? So that we all know that asset prices are going to go up when interest rates go down, right? And that's what we're expecting. Yeah, I get it. But then when the interest rates go up, did we see prices go up too? Yeah. You know why? Because real estate is both what we call a risk off and a risk on asset. They're both risk off and risk on. So, on risk on asset is things like tech stocks and cryptocurrency. So when people are looking for more risk, they just jump into that. Risk off assets are things like gold and real estate. But now we realize that real estate is such a hot commodity, especially in the culture that is.
Especially when there's a shortage of it.
Yeah, and the scarcity is a big part of it as well, right? And so, especially in Australia, right? And there's a whole culture and this campaign going on in Australia that, buying a home is the epitome and a representation of success and stability, right?
Exactly. That is the expectation
exactly right
of society, of lifestyle.
So I wouldn't worry so much about, when is the right time to get into real estate or not. I'll tell you the best time to get into real estate was yesterday, and today you're already too late. So it's not about timing the market, but more about the time in the market so that you can actually capture and ride the growth that goes up. Another group of investors that have a problem with other investors who don't actually invest at all. So, those are the types of people that go, look at this suburb that's gone up 30% in value over the last 12 months. And I'm like, okay, great. So did you buy or not? Like, it's like, nah, I'm just watching it grow up. Like that just does my head in. But opportunity.
It does my head in too, because everyone is an expert in hindsight. Anyone can get a suburb and say, look at this suburb. This went up by 20% over 12 months. You would have made X amount of money, right? Now, unless you mentioned that asset before it boomed, then that's what annoys me. If you haven't done that, it's like you're just looking at data. It's a lagging indicator.
That's right. Doesn't count. That's right. Yeah, what else are we going to talk about today?
Whoa, hold up, Landlord Society.
Are you sick and tired of the rat race and you want to start building wealth with property and generate passive income?
Then come and drop us a follow on Instagram and DM us the word Landlord.
The word what, Charlie?
The word Landlord, like the Landlord Society.
Okay, wait, Charles, what's our Instagram handle again?
At landlord.society.
You heard him, everybody. DM us the word Landlord to our Instagram to learn more about property investing. Now, back to the podcast.
Yeah, so apartments versus houses. Okay, so which one is better? So house and land, where you get that nice land to asset ratio, or an apartment. Maybe it's a new, like a fresh apartment in a 3-story building, not an oversupply of apartments, but you found one that has a really good yield. We have helped a young guy in Perth buy an apartment with an amazing 7.5% yield, which is crazy. Now, I typically, if we can manage it, we would rather people get into house and land, like an established property always, because you're getting the benefits of the growth of the land as well as the ability to control the asset by doing a renovation. But honestly, like I've got an apartment in my portfolio and it's performed just as well as the houses, simply because it's in the right location and I bought it. I knew what I was doing when I made the purchase. So it's not like, it doesn't mean that apartments are bad and you should avoid them at all cost. You can buy them. You just need to understand what you're doing when you are buying them.
Exactly right. I think the key word there is strategy. Like what is your strategy, right? So, you got to understand that, I mean, to give a blanket sort of statement over the two, okay, is this. A Chinese investor could come into a particular town and just say, I'm going to build 100 apartments because it costs 500K a pop. And I can spend a lot less money than that to create them and sell them for a profit, right? Fair enough. That's what they can do. But they've just increased the supply, like massively, in that particular location. And your property, compared to if you owned an apartment in the area, compared to this new one that's going to come into the market, is going to be a lot more dated. Okay, so it's very easy for apartments to become dated, right? Whereas land, you can't create more land. Okay, unless you're God or an earthbender, basically. So it's not going to become possible, right, to actually all of a sudden create another, another thing like the one that you have. You actually, it's kind of like owning a piece of art, basically. You can't just recreate more of them. So, when you expect prices to rise, you got to understand supply and demand. Okay, supply has to be limited, and demand has to increase. That's the thing. Where apartments have grown up in value, that's predominantly because of demand. And guess what? Demand, to be honest, out of supply and demand, what's more easy to foresee? I think supply is a lot easier to foresee. because you can look at a piece of earth and go, yeah, that's a limited amount of earth, and we cannot actually increase the amount of earth within that confined space. So what does that mean? Then when you're buying house and land, then you can actually anticipate that the supply is going to be limited. However, if you are getting an apartment, well, then both supply and demand is going to be it's going to be a tango between the two. So it's harder to ascertain. However, with the right strategy and with the right sort of foresight in mind when you're making a decision to buy apartments, then of course apartment purchases can be good. But I have never seen the growth that some of the house and land properties have seen in apartments. Never.
Exactly. I feel like all factors the same, all strategy the same. You've optimized everything. Typically, the house and land will perform better simply because, yes, you're right. It's easy to foresee the supply and demand equation with the supply of land, that there's always going to be demand there and you cannot create more land. Hence, we have a lot of complex economic indicators that we look at when we're assessing data to buy property. But when you boil it down, a lot of it's quite simple. It's like the land is going to be the thing that's going to make you the money due to capital growth as time goes on.
That's right. But that is to say, then however, the strategy with apartments could be that I'd say the strategy that you need to see out of apartments is that you need to really focus on cash flow. And also it can't just be cash flow that's like, oh yeah, I'm going to put it on rent and rent it out to an international students in the CBD. Like, I mean, it's not just that. You got to actually think about cash flow beyond that. I'd say, we're talking room by rooms and even Airbnb that could really blow out your gains 2-3-fold the regular traditional rental model. Then that could be something that investors need to be ready for before they make the jump into apartments, right? But unless you have that optimized strategy behind apartments, I know an investor that's like, that's in the 100 million bracket, right? They only buy apartments, and they have this amazing optimized strategy where they will just, live off the cash flow of it all, and they do an amazing job. But they have nailed that to the T to be able to recuperate that level of cash flow, of course.
Yeah, I think exactly. Yeah, because they're doing it at scale, so they have access to more opportunity and more strategy.
That's right.
Another topic I want to touch on is principal and interest only. Now, we're not accountants, so this is not advice of any kind, but we're just sharing what we have experienced and the people that we've worked with, what they've done to accumulate extreme wealth much faster, right? When you do things differently to the masses of people, to get results most people don't have, you got to do things most people don't do. And interest only is one of the things that I've spoken about a few times on my social media for good reason. It's because there are a lot of wealthy people that take on interest only loans. The simple reason for that is the way to accumulate wealth through property is debt. That is the major edge property provides. And that like when we're talking about finance, that's the interest. That is the interest side of things. Okay, so when you're taking on more debt, you are giving yourself the opportunity to build more wealth. So why this might sound crazy to a lot of people, because traditionally speaking, people will look at property in terms of, well, I need to pay it down. Let's just make minimum repayments until this bloody thing's paid off, because once it's paid off, then I get to take the next step. It's like, actually, the way to build wealth in property is to give yourself control and access to the most amount of assets. Okay, because it's all about percentages. If you're getting access to $300,000 worth of property on principal and interest, and it goes up by 5%, let's have 15 grand in the year. If you're giving yourself access to, $1 million worth of property on interest only because you've reduced the holding costs, okay, so it's more manageable for you to do this, then that goes up 5%, that's 50 grand. 34, it's a huge difference, right? So that's the power of what's possible. Look at that sheep. He looks friendly. Love it. I kind of like the farm life. Anyway, yeah. So
just want to show the followers that this is what we're dealing with. To try to shoot a podcast, but there's a sheep that comes up to our table.
We make it work, whatever the weather.
We make it work. Landlord society, we make it work.
Problem solvers.
That's it. Problem searchers.
Yeah. We've got to finding problems, we've got to solving them.
Mm-hmm.
Yeah, and the other thing with interest only is that banks don't they don't mind doing it as long as they know that there's an end date. They typically, from speaking to brokers, they might allow you to go interest only for a couple of years, so a 2 or 3 year period, and then at the end of that period, they'll roll you over to interest only. The speculation comes, so the risk comes when you're betting basically that the property is going to go up in value. Okay, now if you buy a shit property and it goes down in value, well, now you're putting yourself in risky territory, because let's say you buy a property and then it falls in value by 20% or whatever it is, and now your loan to value ratio is at 100%. So meaning that the amount of the assets that you have access to that you're holding is at the same level as your debt. That's not a good position to be in. That's a situation you want to avoid. Okay. Now the way you avoid that is by A, talking to good finance brokers and understanding the structure you're getting into, and B, doing your own research and working with professionals in your corner to get access to good properties that don't go down in value. Now, does that guarantee that properties won't fluctuate and go up and down? No, it doesn't guarantee that, but you need to give yourself the best possible chance of the property performing well and going on interest only.
That's right. And another thing about interest only is that it really depends on the nature of person that's right. If you're just trying to buy one house and just live a comfortable life just off one house, and live a simple, I wouldn't say comfortable, because really there's nothing comfortable about a 30-year mortgage. Let's face it. But if you're just looking at buying one house and just live a simple life, then pay it down as much as you can, and that's good on you. But see,
absolutely,
if you're an investor and the whole point of acquiring assets is because it makes you more money, right? Then there really is no good in, putting your money away into just one house. You probably want to just reserve the cash and just go on interest only. And also interest only is also quite, typically people go interest only if their cash flow is really good as well on the assets that you're buying. So it's quite typical of people of investors who are very good at finding good opportunities that really outpace the liabilities basically of the asset itself. So that's really what you're trying to do, whether you're structured as a principal interest or interest only. But as long as you're outpacing all the liabilities of your life, and more importantly the asset itself, then you can be sure that every property that you buy is going to make you more and more money. I mean, the statistics, it says that people who out of the people who buy investment properties, 80% of investment property owners, right? The first, I always struggle to phrase this, but the 80% of investment property owners do not move on to their second investment property, meaning that only 20% of the investment property owners will move on to their second. Now, I always ask the question, are they doing that A, because they don't want to, or B, because they can't afford to? And the clear answer,
C, because they don't know how to.
Yeah, but C, and that's and because they don't know how, that's probably led to because they can't afford to. So, if owning investment property was something that made you money and made people happier because it made them more money, then why wouldn't they buy more of it unless they couldn't afford it? So that basically says that 80% of investment property owners who own one investment property just cannot afford to move on to the next one because they've done something wrong, basically. And oftentimes, as long as you have the right property deal and it's doing really well, it makes very little difference, and there's all this talk about, principal and interest and paying down the loan faster and whatnot. But literally you're pushing pennies around compared to the opportunity that you could have had by having the money invested elsewhere. So I'd say that should be the focus rather than this is something that, if you have a $10 million portfolio, then saving interest on $10 billion portfolio is going to be very, very significant in the short term and in the long term. But until then, I'd say the focus should be not on how you structure the loan, but more importantly, how can you find good enough deals that you can actually, amplify your portfolio as you move along.
Exactly. It's all about, it's so important, the property that you get access to. That can make or break your future. You know, that will pave the way, really. The first one that you get into will be the one that paves the way moving forward. Another thing I wanted to quickly touch on is granny flats. I think granny flats, they are becoming popular. These are something that I've been doing for the last 4 years now, okay, just out of COVID, just ever since. And they're an absolute dream. I think one of the reasons they work so well is because they're a decent quality living situation. I know on social media you might see people talking about how shocking it is that you could rent out a granny flat and expect someone to live in it. But in those cases, usually it's just someone putting a couch in a shed. That is not being a good landlord. That should be regulated. The one that we're talking about is a proper construction. It's like an apartment. You know, a nice kitchen, beautiful little area, like quaint, looking nice, high quality slab, everything, like little patio with side access, your own driveway, the whole thing. Okay, so you're looking at, for something like that, it's like $100,000 plus, $70 to $100,000 depending on the size. Does that add value to the property? Now, in some cases, yes, but not proportionate to the amount of money that you would otherwise spend on a fixer-upper or a buy, renovate, like a BRRR property, like a buy, BRRR, right? The buy, renovate, reinvest, repeat, so on. So an additional, like an existing property, like an established property that needs work, if you renovate that, you're going to build more equity doing that if it's the right property than you would if you spent money putting an Airbnb, a granny flat at the back of it. So for example, if you've got a $600,000 property, you spend $100,000 in a granny flat, it might be worth $700,000 after that. Really though, the demand isn't, if you think about who's buying those things, it's not going to be mum and dads, right? It's going to be more investors. That's where the demand is going to come from. So that's a commercial interest. And when you think about commercial property, they're valued based on the rent they provide. So if you could carry that over to the granny flat, yes, it's going to add some value, but not because you've made the actual dwelling itself more valuable. You've made it more of an investment, a cash generating machine.
That's right. You've increased
cash flow. Yeah. And also you can build a granny flat without having to use any of your own cash if you have equity somewhere in a property that you might have renovated or you've bought really well somewhere and that's gone up in value. Now you get to use that equity, you get to dip in, not exceed that 80-20 loan to value ratio, use that equity, do the construction for the granny flat. Now you've got an extra, whatever, like 50 grand a year. Depends what kind of granny flat it is. Usually, it could be $30,000 to $50,000 a year, depending on the quality, the location, number of different things. Yeah,
correct. Yeah, I mean, granny flats are. I mean, but I wouldn't be too pessimistic about the equity uplift of granny flats. I mean, in the right areas, granny flats do become quite desirable, and if it's done really well, then it becomes an extension. In which case, people will love that kind of stuff. You could attach some serious emotion onto that property and sell it at an absolute mint as well. So, as long as it's in the right area, you could be looking at some pretty good equity uplift as well. But there's undoubtedly the cash flow situation is absolutely unbeatable. You did mistakenly call granny flats Airbnbs, but
I did. I accidentally almost did. Yeah, I think that's that point. There was method in the madness when I said that, I think.
Exactly right. I mean, because like Airbnb in granny flats are becoming, in the right locations, of course, are becoming extremely lucrative at the moment. People are retiring, off of, just one house doing that kind of stuff at the moment as well. I know many investors who's done so well, and especially around the wake of COVID, people love the short-term options as well. I know this one particular investor who was able to add a pool into her house because it was so bloody lucrative, and just retired basically. That she paid a pool in cash and just went for it. And so really it's about venturing out into an investment that that you can forecast the cash flow and make a jump, I guess.
Absolutely, yeah. Locations. I know that, Sydney, very obviously most expensive. We've got Melbourne, not too bad. I think the three big ones though, Perth, Adelaide, and Brisbane. They are what we're seeing is the most affordable. That doesn't mean there isn't opportunities if you're in Sydney. By the way, you can also buy interstate. It's quite rewarding when we help people buy property when they're from Sydney and they can't afford to buy a house to live in, but we've helped them buy a property in Perth. So that is something to consider if you feel like you're limited based on the city that you live in. Don't. It's just about the right property that you get into, is the property and the property manager, the team that you have by your side. So, it's not all. There's opportunity. We say this all the time, but there is opportunity in every single market as long as you can afford the property and it's got in a good location and you have the right strategy and the right team behind you.
And it's all about the entry, guys. I mean, property market is always going to be on an uptrend. And so understand that, it's no point watching markets go up, but, every point is in, riding that wave. So climb the asset ladder and you'll be able to get to your financial freedom a lot sooner than, I guess, your career will.
Yeah, absolutely. Yeah, for sure. So that's a wrap, guys. Hope you enjoyed that episode.
You guys know where to find us. Thank you so much for tuning in to today's episode, and we will see you in the next one. Go find us on Landlord.Society and Instagram, and of course drop a follow on the Spotify as well, and we will see you next time. Peace out.
See you guys. Bye.